Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, founder and owner of Menninger and Associates Financial Planning. I'm really delighted to have a special guest with me today, Thomas Balis. Thomas, thank you very much for joining us.
Super to be here.
Thomas is a CFA, a chartered financial analyst, the only other designation in the industry that I have the greatest amount of respect for. These guys are the investment gurus. Thomas is the founder and owner of Cornerstone Portfolio Research, which is a group of CFAs, much like we're a group of CFPs who do in financial planning. They're a group of CFAs who do a lot of investment research and help financial advisors. And in fact, his group, we use them as consultants for us and for our clients. So, Thomas, thank you again. Do me a favor, take a couple minutes and tell me about yourself, your background, and the company that you founded a few years ago.
Yeah, absolutely. And so my passion has been for many years in helping advisors help their clients achieve their goals and dreams. And so I spent a lot of my career working at a local registered investment advisory firm as the chief investment officer. And 3.5 years ago, founded Cornerstone Portfolio Research to be able to broaden our reach, to be able to help multiple advisory firms and specifically provide tailored guidance to create investment programs that would allow them to more customize the portfolios that they provide for their clients. And so I get out of bed every day because I feel like we're helping advisors help their clients achieve the best possible outcomes.
It's great. If you don't mind me asking, how many advisor clients do you have?
Yeah, so we support a dozen firms across the country for just under $5 billion in assets.
Nice. I know you guys have been a terrific support for us and greatly appreciated. In fact, you may not know it yet, but the guy within your firm that you assigned us that we work with on a weekly basis, we're looking at doing these episodes on a monthly basis. Mm-hmm. So, each time he does a write-up for a monthly, we'll probably do that and have Brad's pretty face. Now that we just got Zoom capabilities.
Oh, that's awesome.
So, forgot to tell you that.
Well, Brad is one of our top guys on the team, and I know he really enjoys the partnership here with the firm, and I'm sure he'll do a great job.
I'm sure he will too.
He'll probably do better than I will.
I'm not going to be the one to say that. All right. Now, you've both been great. I mean, and you both bring in different styles, and by the way, I don't care what it is, who it is. Two heads are always better than one.
For sure.
And I'm a believer in that.
No, investment is definitely a team sport.
Oh, absolutely. No doubt about it. And as is financial planning. Mm-hmm. It's no one has a corner on all of the great ideas. And as you know, in your world, there's different views on different things. None of them are right. They're just different. And it's always good to aggregate different views, et cetera, et cetera. So what we're going to do here is we actually have a lot on tap. We're going to actually make 3 episodes out of this that are going to be airing at 3 subsequent weeks. So to be clear, because of the fact that news occurs, the economy flows, the markets flow, obviously we have daily changes, et cetera, et cetera. But what we're going to do is we're going to do 3 episodes on this. And I just want to be clear that today is July 19th. Which means that if something happens between now and the time that an episode airs, it is possible. So the 3 episodes that we're going to be doing today, we're going to be discussing kind of what happened in Q2, market update, economic update, and try to trim that to a half an hour, right?
Uh-huh.
The second episode, which we were going to do as the third, but given the timeliness of all of the political stuff that's going on, is what happens from the election perspective. Now, we're not talking about what happens if the Republicans or Trump wins, what happens if Biden or whoever the potential candidate may be wins, which is also part of the reason. As of today, President Biden is on the ticket, but I think we all know that there's a possibility that could change. So that's part of the reason why we pushed it from being the 3rd episode to the 2nd episode. And even then, by the time this airs, it is entirely possible because they're talking speculation that there's a possibility he may resign from running for the election, not resign from the presidency, but resign from running for the election. But the long and short of it is, it's not about the individual per se. It's typically about the platform of the Republican Party versus the Democratic Party.
Exactly.
And to that point, we want to take a little bit of time and talk about that simply because it is on a lot of people's minds.
Absolutely.
Okay. And truth be told, I'm not a fan of politicians and what they say in their campaigns and what they actually do aren't always exactly the same thing.
That's for sure.
And so I'm passing no judgment on anybody other than that. And then the third episode will be talking a little bit, going back to broader economic discussions. More so the Fed. Don't fight the Fed. Okay, the Fed is, raising interest rates, lowering interest rates. What are they going to do? What's their policies? Because they drive a lot of the things where the economy and the markets go. And then what have been the drivers lately? And I think it's been AI, artificial intelligence. But we're going to talk a little bit more about that. So you ready to jump in for today?
Absolutely.
All right, awesome. So Thomas, why don't you jump in? We'll take a look at the first slide. Like maybe what's going on in Q2? We had a decent Q2, but Q2 is, once again, driven by a small segment of the market.
Absolutely. And, if you take a look at just the Q2 results, and you look at the market, say, for example, the S&P 500, which tracks large U.S. companies, the market was up 3.5%, 3.6% in the month of June, up 4.3% throughout the quarter. And so if you just stop and think about that from a quarterly perspective, Mike, if it was up 4% every quarter,
16%.
16% a year.
I'll do that.
I'll take that. And if you look at it year to date,
to think about it compounded too.
Yeah, for sure. If you look at it year to date, we're up 15% through the year. That's through the end of June, up a little bit more even here in July.
Right.
But if you'd have asked me at the beginning of the year that we would be here by the midpoint, I would have been surprised.
Oh, I would have been happy.
I'm thrilled.
I am happy. But
I'm thrilled. But one of the things that we saw in the second quarter was that it wasn't necessarily broadly across broad markets. While U.S. large caps did quite well, we saw a rotation within the quarter, where mid caps didn't keep pace. In fact, mid caps, those medium-sized companies, think like Domino's Pizza, those kinds of size companies, those pulled back in the quarter. Your smaller companies, small cap stocks in the U.S. also pulled back in the quarter, and even international kind of pulled back a little bit. And so it was really, if you were going to win, you needed to be in the U.S. kind of large company segment in the second quarter. And then, of course, when you take a look at bonds, we continue to have bonds just kind of, plod steadily along. There's been a little up and down as rates have moved up and down with some of the Fed guidance, and we'll talk about that in a bit. But really, the story in the second quarter has been U.S. large caps.
Right. Well, it's not just the second quarter, Thomas. I think we can be saying that for the last year and a half to 2 years, it has been driven. And to your point, you had said earlier in the year, we were beginning to see the broadening out of the markets. Mm-hmm. In fact, we were seeing that again in July, but we were seeing the broadening out of the markets, and lo and behold, we had June occur again.
Yeah, we've certainly seen the market do it a few times. I mean, where we saw early in January, we saw some rotation in April, where it seemed like some of the capital flows were kind of spreading out amongst other sectors and other parts of the market. Even here in July, we've seen a couple of days where, like over the last week, very recently, you saw small caps really outperform their large cap brethren, and specifically those AI related stocks, that Mag 7 team, if you will. And so there's definitely been fits and starts where the market has tried to broaden, but the AI trade has been so powerful that it just keeps coming back around and flows keep heading that way. There's a lot of FOMO there. Folks are afraid of missing out.
Correct. Fear of missing out. That's correct.
For sure.
So talk a little bit about AI, artificial intelligence. What do you mean by an artificial intelligence stock? I mean, I know, but for the sake of the viewers, what do you mean by that?
Yeah, so you think of artificial intelligence and you think of things like machine learning, you think of large language models, and that latter is actually what kind of grabbed public attention. When we saw ChatGPT 4 come out and all of a sudden it started gaining some mainstream use, we saw AI come to the forefront of the news cycle and frankly, market attention. And then you saw NVIDIA, come out with these incredibly powerful chips that are very much suited to helping, these AI programs train themselves. They help with machine learning and so forth. And these chips in specific are really helping move the ball forward. And so you started seeing large tech companies really make significant investments in these chips. Think Microsoft. Think Apple even partnering up with
buying the chips from NVIDIA.
Yeah, and teaming up with OpenAI. You think Google. When you do a Google search now, you see there's AI powered results, if you will. And so in some ways, artificial intelligence has become more synonymous with broader tech, but specifically in the chipset, companies like NVIDIA, have just have taken off astronomically.
Oh, astronomically is a word you can use. It's up like 300% in the last couple of years, not even?
Yeah,
Less than a couple of years?
Well, and they've definitely shared the love. It's not just been them. If you take a look at the next slide and you look at the price to earning ratios of AI-related stocks, just compare it to the other stocks in the S&P. And on this chart, I believe there's around 50 stocks that are included in that AI group, if you will.
Yeah.
But you can see that those stocks are trading at a premium. They're getting a higher price per dollar of earnings than what you're getting if you're non-AI related stocks down on the lower line. And again, the rest of the S&P 500 is trading at an above average multiple as well now.
Right, that's correct.
We've seen multiple expansion this year. But if you're an AI related stock, and especially one of the big ones, and again, back to NVIDIA, not only are you commanding a much higher price to earnings ratio, these companies are very different than the tech companies of the 2000s during the dot-com bubble burst.
What, because they're actually making money?
Because they are making mountains of money.
Right.
The amount of cash that they are generating is staggering. It is truly staggering. And so when you have these mountainous increases in profitability, and NVIDIA can charge whatever they want for these chips because they're the dominant player.
Well, not only that, but they have such a backlog because, all these other companies, the Apples, the Microsofts, and whomever is buying it, they have a long lead time.
Oh,
and
for sure.
Once again, fear of missing out, but from a different perspective. Hey, I want to order chips, and my backlog's a year. Well, I'm going to project out how much am I going to need for 2 years, and I'm going to put those chips orders in now. And so that's really helped launch NVIDIA.
Yeah, no doubt about it. And so you see these AI-related stocks, whether they're NVIDIA or they're amongst other related companies or tech companies that are heavily involved in AI, like a Microsoft or an Apple or a Google or a Meta or what have you. We're starting to see AI actually broaden out into things that regular people like you and I actually touch and use. So it's not just this theoretical concept that you think about when you watch an old rerun of the Terminator series. It's real. I looked at new TVs over the weekend, and the TV chips and operating systems now are powered by AI in such a way that the sound improvement coming out of the native speakers in the television is so much better that you might not necessarily have to have that sound
and that's AI
anymore. And absolutely powered by AI. And the pixelization, they say they're actually looking at the colorization throughout the film in order for you to see the colors and the color schemes as the director would have intended in the filming process. And they're using AI to power that decision making within watching the TV. So
interesting. I wouldn't have thought of it that way. It seems more kind of hardware, if you will, than it would be AI. Give me some other examples. You talked about NVIDIA, and you talk about like ChatGPT or I think of AI as like doing a Google search, okay? And what other applications are there, and who are the big players? We refer to the Mag 7. The Mag 7 is those 7 stocks that have done extraordinarily well over the past year and a half to 2 years. That's your Microsoft, your Apple, your Google or Alphabet, Meta or Facebook, NVIDIA, Amazon, and Tesla. Okay. Those are examples of AI companies, but they're using it for other applications other than, as I think of it, as the chat GPT and things like that, right?
Yeah, certainly voice recognition software. And that's true whether you're saying, hey Siri or hey Alexa, but also when you're on the phone queue and it's not asking you to press a button, it's actually asking you to say your birthday.
Right.
That's using AI.
I've been using that for years, though.
It has been. And it's getting better and better and better because these chips are helping these large language models learn so much more efficiently, get even better at recognizing your speech, not having to maybe enunciate quite so clearly or use certain keywords. There's a lot of talk that some of these voice recognition systems, the improvement that we would expect to see as these large language models continue to improve just is expected to be exponential. But then the other side of it that doesn't really get that much press is you're starting to see more small language models where you see artificial intelligence being used and trained specifically like in the biotech space to solve very specific biotechnical issues, whether you're researching in pharma or disease or whatnot, getting very, very specialized instead of all being about large language all of the time. So, the uses are filtering, all throughout the economy. And if you take a look at the sector slide that we threw in there, you saw in the second quarter, we saw that, technology and communications were the big winners.
Well, who's communications? That's Facebook and Google?
For sure.
Okay. Yeah, and those are the big boys.
Those are the big boys, yep, for sure. But even beyond there, you saw kind of a derivative play there in utilities where people understand that, hey, we got to have power,
right?
In order to provide enough, electricity to power these massive server farms that have these GPU chips in them for the AI to train itself. And so, there's that play, but you're seeing AI and tech spread out amongst other sectors of the economy too. And I think that's been some of what's been behind some of these attempts for the rally to broaden. You think of healthcare and the biotech, like I mentioned. You think even of financials and the impact that AI can have on managing their cost structure behind the scenes. And so there's no doubt that AI is becoming a more significant driver across all sectors, or most sectors anyway, within the U.S. economy. And so I don't think this trade is going away.
You know what it reminds me of? The AI being introduced into society, if that's the right word, reminds me, and how broad-based it is by what you're talking about, is almost the invention of the internet. Mm-hmm. You're like, oh, well, what am I going to need the internet for? I remember the fax machine came out. I'm like, what would I ever need a fax machine for? But here we are today. I just see it as being changing everything.
Well, and that's where the FOMO has come in, is that if you're a large company in the U.S., and especially if you're in the tech space, but even for a lot of non-technical companies, this is not an area that you can safely afford to ignore.
Right.
I mean, it's going to become table stakes. It already is table stakes in things like internet search,
right?
Where it's and it's been there for a while, but now they're branding it and they're calling your attention to it. But,
right.
Even things like getting an AI summary of a Zoom meeting, that we have, when we meet with our client firms, that's become almost commonplace now instead of something new.
Right.
And so, I think we'll continue to see, this increase in AI capabilities, this broadening out of its use spectrum to the everyday people.
Sure.
In our everyday lives. And we'll certainly continue to see it, I think, within U.S. markets.
Good. Well, I'll tell you what, we're going to take a break here because then we'll fold in for the next segment. We're going to talk a little bit more about the Fed, what their role is, and inflation, et cetera, et cetera. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner. And I'm here with Thomas Balis, chartered financial analyst, the CFA. In the first segment, we were talking a lot about what happened in Q2. We had a rally mostly driven by the artificial intelligence, and then we kind of expanded upon the artificial intelligence, which is good because much like the internet, as we left off, it ain't going away anytime soon.
Absolutely.
Okay? It's going to be part of our daily lives. So what I'd like to talk about now is, for the remainder of this, is to talk about the Fed. Oh, don't fight the Fed is what they always say. Well,
That's what they say.
Fact of the matter is that the Fed has two mandates.
Yep, absolutely. And so stable employment and stable prices. I mean, those are really the two different things that they focus on. They want to have maximum employment within the U.S. economy. That full employment level, most economists say that's around 4% or so unemployment.
Right, which we're below.
Well, we just ticked
Oh,
up
which
above
we
that.
just, that's right, that's right.
Yep. And then stable prices. So those are the two mandates that the Fed has.
Well, unfortunately, stable prices has not occurred.
For sure.
So, we experienced in 2001, I think it was July or June or July of 21, the highest inflation that we had since 1980, 1981. And that set ripples through not just the economy, but the markets.
Absolutely.
Bonds don't like a rise in interest rate environment, but fact of the matter is, Fed policy is price stability, and rapid inflation is the opposite of price stability. So one of the Fed's jobs is to control that, and their way of controlling it is to raise interest rates, because the idea of raising interest rates is supposed to slow the economy down, because when you slow the economy down, then the inflation will come down with it.
Ostensibly, yes. And one of the big drivers behind the inflation that we've seen, in addition to things like the fiscal stimulus that came out of COVID and so forth, was that the Fed was initially slow to react. I mean, they used that transitory phrase, quite a while when inflation initially started to increase.
Right, I remember that.
And I don't think there was any malice there. I think that's what they genuinely believed the facts were showing. But the amount of stimulus that came into the economy was such that it wasn't transitory, and prices continued to increase and continue to increase. And then when they did react, policy's not instantaneous. It
takes time.
It takes time. It acts with a lag, and so it's inflation. When they did start to act, we got down from that 8% range to that 4% range relatively quickly within a year. But then getting from 4 to 2% is really proven to be much more challenging for them.
Right, because the single largest component of it, at least right now, is shelter. Mm-hmm. And as we can tell from people who are looking at renting and people who are looking at buying, the real estate market has absolutely shot through the roof in the last handful of years, which I didn't even know there was an index until Brad literally sent it one time, a housing affordability index, mm-hmm. which was at its worst in decades, if not ever.
Well, and the other piece of that continues to make it difficult is consumer expectations around inflation. And so in some ways, inflation is built a little bit upon a self-fulfilling prophecy of what we think about potential inflation in the future. And the reality of it is that sometimes as just normal people, we get a little bit confused. So we think of high inflation, we think of like groceries, for example. Well, groceries for my family have become much more expensive over the last several years than they were prior to that. And I think most Americans can probably
That's what they
relate
say.
to that. Yeah. So, we think of that. Those price increases aren't coming back. They're not going back down to where they
if
were.
inflation goes down, it doesn't mean prices are going down.
Exactly.
It's that the rise is slowing down.
Right, but our perception when we keep seeing that massive bill at the grocery store or the gas pump is that inflation is high. Even though inflation has actually slowed some, doesn't mean just because inflation slows down, that just means that the rate of increase is smaller. It doesn't mean prices are going down.
Yeah, we're stuck with them.
We're stuck with them. We
That's
are
right.
stuck with them. And so, I don't think the grocery store is going to get any cheaper anytime soon. That doesn't mean that inflation isn't coming down. It is, but our mindset has to really kind of adjust to the new reality.
Yeah, I know, and that's kind of stinks a little bit.
It does.
So there's a chart here that shows inflation over time, and you can see that it was hovering, at least the chart goes back for about 10 years, and it was hovering in the 2% range for a whole bunch of time, and all of a sudden, boom, in 21, it shot all the way up to, as I pointed out, I think it was 9.1 it hit, and it's come down, and you can see, but the rate of coming down, it's almost now looking at the chart, the overall inflation has actually remained flat. I mean, a little bumpy, but it's remained at 3% for what? Almost a year or more.
Yeah, for sure. And we've seen that come down. We've also seen core inflation, which takes out the kind of more volatile energy prices and food prices, down to 3.3%. And just as a note, there are a couple of different measures of inflation. There's the consumer price index, which we're referencing here in the chart, but also the Fed uses the personal consumption expenditure.
Right, PCE.
Yeah, PCE. And so that's a measure that has a little bit less housing or shelter costs in it. But by both measures, you've seen it come down, right? But we're not at target. We're not where we want to be. It's not down to that 2% that is the Fed's target. And so, we'll in an upcoming episode, we'll talk more about future Fed policy. But just looking in the rearview mirror, we've seen some pretty significant shifts in the way that the Fed has been projecting, the interest rate policy, even for 2024. Coming into the year, there was an expectation that there were going to be, the market was pricing in 6 interest rate cuts coming into the year, and then it backed it down to 3 interest rate cuts, and then it finally backed it down to 1 interest rate cut this year.
But now it's coming back up again. Isn't there expectation of 3?
It depends on who you're reading. Certainly,
the bond market.
The forward-looking pricing is pricing in September, and we'll talk a little bit more in the next episode about kind of the cuts after that. I mean,
right.
It depends on what's going on the day. I mean, bonds have become much more volatile than they used to be, sadly, in terms of longer-term interest rates. But
well, that's also for other reasons. I've been reading about China's been selling off the U.S. bonds, et cetera, et cetera. So, the other thing, too, is that you referenced earlier about it takes a long time for the Fed policy change to impact the economy. If, in fact, it has dropped as fast or as much as it has, it may not have reached the 2%, but the concern is that the economy is slowing. Mm-hmm. And the concern is, and the Fed has a history of raising interest rates and driving the economy into a recession. You'd almost think that they're going to get ahead of it. They already made the mistake of being too late raising rates. I would almost think that they should be lowering rates sooner to at least get that ball moving. You can argue both sides of that.
Well, and I think there are many that do. And so the thing that they're trying to balance is they don't want a repeat of what happened in the 70s, where they were too quick to cut rates and inflation pressures
came back again. Yep.
And so they want to make sure that they've got it truly nipped in the bud, but at the same point, they don't want to run the economy into the ground. And so, you take a look at things like new unemployment claims. I mean, that's a lead indicator of what's happening in the economy. And recently, we saw those claims tick up. I think yesterday they came in like 243,000. And that's above what they have been. We've seen the unemployment rate tick up from 3.8 to 3.9 to 4.1%. And so we've seen wage growth start to slow as the job market, the number of job openings that are out there per job seeker has come down to significantly to close to pre-COVID levels. And so these are indications that growth is slowing. It doesn't mean we're in a recession, but growth is slowing, which was the Fed's goal, because as growth slows, that should bring inflation down. And so they're just walking a very fine line to, hey, we want to get ahead of potentially running the economy into a recession, because we know that policy acts with lags. And so there's some pressure to cut sooner than later. With the other side of it is we don't want to cut too soon.
I know.
And have inflation come back. And so it's a fine line. The Fed meets later this month in July, I think, probably around the airing of this episode. And so there's not a lot of expectation that they'll take any action in July. But the current thinking is that
September.
Even some of Powell's public commentary recently has indicated that September is very likely.
Well, you know what? It's very easy to criticize the Fed, Monday morning quarterback, But I'll tell you what, to date, he's done a whale of a job. We are out of time, but I do want to take 1 minute if you could. You also produced a slide on producer price index, and you see it ticking up. Can you just talk real quickly about that?
Well, we see PPI as a precursor, and that's something that feeds into CPI, because as producer prices go up, that means they charge more for those goods or they take lower profits, one or the other. Companies don't like to take lower profits, and so you could see that feed into CPI pressures going upward again, and that's one of the reasons that the Fed hasn't done those 6 rate cuts this year.
It's cautious. It's being cautious.
For sure.
All right, great. Thomas, thank you very much.
Absolutely.
Thank you for joining us. We will be with you for another episode. On the next episode, we're going to be talking about the impact of elections or not the impact of elections and what the different policies are for the Democrats versus the Republicans as it pertains to their policies on the economy, et cetera. So thank you for joining us. I look forward to seeing you next episode.